I made a claim in an interview. First of all, he went through one 70-minute video, and I engaged with him in his chat stream. And he went through one 70-minute video. That was an interview that I did with a person on somebody else's channel. It wasn't even the Life 180 channel. It was somebody else's channel that I did this interview on. And in there, one of the claims that I made was, and this is a claim based on a conclusion that I came to after a conversation with an actuary. And the conversation that I had was life insurance companies started selling and focusing on selling more IUL because it was a way to shift risk from, I'll answer that in a second, Christian. But life insurance companies started selling IUL as a way to shift risk from the insurance company to the insured, right? Because remember, with a whole life policy, you are partnering with the company. The guarantees are all benefiting the individual, and all the risk and liability to meet those guarantees falls on the insurance company. With an IUL, the opposite is true. There may be a little more upside on paper, but at the end of the day, the risk falls on the insured, and all the control ultimately falls in the hands of the insurance company. And so that's one of the reasons that fundamentally I have a big problem with index universal life, because to me, the number one attribute we're looking for in any asset is control. And so with IUL, you don't really control it. The insurance company does. And I'm going to get into that here on how that works exactly. So Christian says, hey, Chris, is it possible to turn an already existing policy and optimize it going forward? So it depends. On an IUL, I would say there's always going to be variables in an IUL that you're not able to control. Can you optimize it? Well, it depends on how bad it is. You could probably make it better than it is, but you're never going to be able to position an IUL where you're in complete control. You can never fully pay an IUL up. I did a video the other day talking about what is more expensive, whole life insurance or index universal life. And when you get into the retirement years, index universal life can never be fully paid up. So you're always paying annual renewable term on the net amount at risk. So when you get into your 80s, even if that net amount at risk is a small number, the cost of insurance fees on that, because it's annual renewable term and based on your age, it's super expensive. Not to mention the policy's highly unlikely to perform as it was illustrated. And Bobby Samuelson at Life Product Review, who, by the way, I'm interviewing again on Friday. Those videos will probably come out next week with Bobby. And Bobby's just probably the best product mind in the industry when it comes to this stuff. So I'll be having him on here again. And so make sure you're subscribed and whatnot to the channel, because I think that'll be really beneficial to everybody that sees that. He's just a wealth of knowledge, for this stuff. But here's the deal. I made the comment that the reason life insurance companies were selling more IUL was to shift the risk from the insurance company to the policyholder, because rates were coming down, and there was a lot of stress on the general funds of the life insurance companies. And guess what? That remained true to this day, right? That's why the changes in Section 7702 happened. That was all because of the stresses on the balance sheets of the life insurance companies. That way, the life insurance companies could reduce the guarantees from 4% to 2%. That allowed them to redesign the way that they structured these policies. Now, that happened with whole life and IUL, but these stressors have been happening for a couple decades, right? Because interest rates have been going down and down and down and down and down for literally decades, right? Since 1980. And so it all kind of hit a tipping point. Now, his response to me was like, in the thing, he basically said I was lying because of the fact that, the three biggest life insurance companies, whole life, mutually held whole life insurance companies, which are Northwestern Mutual, New York Life, and Mass Mutual, did not sell index universal life. So because they did not sell index universal life, I must be wrong. I must be lying. I don't know how I came up with this cockamamie idea that this would be the case. And so here's my response to this. So I think this is going to make a lot of sense. So it's important to know that right now, there's about 70 companies that are selling index universal life. Okay, 70 companies, give or take, and some come and some go all the time, right? 70 companies, ballpark, right now, that are selling index universal life. Back in 2011, when I was a director of business development for National Life Group, back in 2011, there were 14 companies selling index universal life. 14, that's it, right? And so when we look at the numbers, we have to go back and not look at it in today's environment. We have to look at it back then, because they were the trailblazers, right? They were the people that were forging the industry, right? Because remember, back in 2011, this was pre-regulation AG 49. It was completely the wild, wild west. You could illustrate IULs at a 9%, even a 10% assumption at times. There was a couple carriers that did that, was just completely absurd. But it was pretty commonplace to illustrate at like 9%. 9.1% was a very common illustrative rate that people were using. And then when you look at that, we had with 14 carriers, there were it was a battle between some of the big players in the market. There was Pac Life, there was Minnesota Life, there was National Life Group. Those were always three of the top four. There were a couple other big players that I wanted to say: John Hancock, Prudential, National Life, Minnesota Life, Pac Life, Penn Mutual, MetLife, Principal Life Insurance. And so, like, remember, if we go into this, okay, and we look at this and we say, all right, IUL was created in 1997, okay? So in 1997, Transamerica came up with the concept of IUL. From that point forward, now it's important to know, and the second point was, he said that IUL was actually created as a response to the stock market, right? Like as a response to the market volatility in 2008. Well, guess what? That's what made it more popularized, and I'm going to get to that in a second. But that has nothing to do with why it was created. And so when we look at this, when I say that it was used as a way to shift the risk from the insurance company to the insured, this is what I'm talking about. So IUL created in 1997. These are all the big players. These are the biggest players out of the 14 companies that were selling IUL in 2011. Okay, and so John Hancock demutualized 1999. Prudential demutualized 2001. Minnesota Life demutualized 2005. MetLife demutualized 2001. Principal Insurance demutualized 2001. So when we look at this and we look and they started selling Index Universal Life and they had to fall into that model. Now, did they have to demutualize to sell Index Universal Life? No, the answer is no. They didn't have to demutualize. But these were the leaders of the industry at that point in time. These, like, when we talk about mutually held life insurance companies, I mean, these are some like massive players in the industry who used to be just staples of the industry. John Hancock, Prudential, MetLife, Principal, like those are massive companies back then. And they all demutualized at that point in time because they started selling Index Universal Life. And they decided to shift their business model. Now, just because Mass Mutual, New York Life, and Northwestern Mutual didn't go this route, honestly, I think they deserve a badge of honor, right? Like they didn't do it. And there's a lot of other companies that didn't do it as well. Companies like One America stood their ground. Companies like Lafayette stood their ground, even though Lafayette has Columbus Life, and Columbus Life is like the IUL branch of Lafayette, right? So like at least it's a different company, right? Like, and that's hard because I like Lafayette and I like a lot of what they do. I don't like the fact that they have a sister company that sells IUL. That just is what it is. But at the same time, it's at least Columbus Life, it's a profit center. Lafayette is backed by Western and Southern, and so there's some good financial stuff there that gives their good backing. Excuse me. So that is what it is. But then you have other companies like National Life Group, Pac Life, and Penn Mutual, who are all still pretty big players in the IUL space, and they are all still mutually structured companies. National Life Group and Penn Mutual are top three. National Life Group is the #1 company in the country right now in the industry when it comes to IUL sales. They are still a mutually structured company, and Pac Life is still really big. Now, back in 2011, we were looking at National Life, Pac Life, and Minnesota Life were always kind of in the top four. They flip-flopped. Pac Life was kind of the dominant factor that was really doing more than anybody else. And so it's interesting to me when David comes out and he says, I must be lying because of these three things. That bugs me because that's like a total half-truth that he either doesn't even understand himself, which I don't think is the case, or he just decides to omit all of this information, or he just doesn't even understand what he's selling himself to begin with. And this is the environment that led to the environment that we're in today. Now, the challenge with this is that back in 2011, when this was happening, it was still very much so the wild, wild west, right? We had all these companies that were doing it and a couple more. And it was still the wild, wild west. You could illustrate 4% positive arbitrage It was, there was really no limitations. The expectations were completely out of alignment with reality, right? Like, and so the products that were sold back then, anybody that bought them, it's not that they're horrible. It's not that the policies had to lapse. They could perform okay if they were funded properly. But the problem is the expectations are way out of alignment. And as you know, the way that IULs actually work is the cost of insurance is all based on the net amount at risk. And so if the policy is not performing according to the 9% assumed average that it was run at, like David in his video, this is the other thing, I guess I should talk about this. David in his video said, oh, since 2006, we have policies that have averaged 7%. Well, that's great. Who cares? The market, S&P itself is averaged way higher than that. I don't know. I think I did the numbers on it. It's like 10.21% or something like that it's averaged since 2006, even with the crash of 2008, right? So when we look at that and we go, okay, the market's averaged 10.21. This is our policies have averaged 7, and that's not a net number, by the way. That's a gross number. So then you back up the cost of insurance and all that stuff. My guess is it's probably 5.5 or 7. But the bottom line is you look at those numbers and you're like, okay, if that's it, but it was run with a 9% assumption, right? Like if we look at the IUL challenge, it's all about expectation management. So all their cost of insurance on the IULs, even if they're doing 7, they're going to run into problems down the road because the illustrative assumptions are based on that 9% every single year, right? And so when they get run at, when they're actually performing at 7, that may not be horrible, right? If you compare it to today's metrics, right? But when you compare it to how they were sold, it's an atrocity. And you have to also remember that we just came through the greatest bull run that the history of the market has ever seen. So over the past 10 years, if we have seen, that these are sold on upside potential, which they are, and downside protection, if they are not really gaining any upside during the greatest bull run of all time, well, where's the potential in that, right? Like, and the bottom line is, and I'm going to show why this is the case, but the bottom line is the policies, really the performance of the policy is not really correlated to the performance of the index. It's really correlated based on the options budget and the options cost, which impact the cap rates, the par rates, the spread charges, all these different things. And so that's really what determines how the policy performs. It doesn't matter. All these policies that were sold back in 2011, I was seeing it, they had 14.5 to 16% cap rates, right? And so if I sold you a 15% cap rate and it was a 9% assumption, well, that looks pretty good on paper. But now what happens is the cap rates on those same products have been reduced to 9.5%. So the cap rate is just barely where the assumed every year expectation is. So they could barely hit there on a top year at this point in time. So there's zero chance that policy ever has to perform the way it was sold. That's why I created the IUL challenge. Now, as we go through now, obviously cap rates are lower, expectations are lower, but we also are running into a situation where the next 10 years is not going to look like the last 10 years, right? We are not going to have this bull run continuing. Hopefully it's not a decade of horribleness, right? It's not a decade of contraction and debt and inflation and all these different things like the 70s that really happened. Like if we have that happen, we have a lot of problems, and IULs are definitely in a lot of trouble. And it'll happen fast if that happens, if that environment happens. Now, hopefully the market is just kind of like steady Eddie, and it just is, we don't see a ton of growth, but we don't see a lot of downside either. The market kind of sorts itself out, and we don't know what's going to happen. That's the bottom line. But even if that happens, it's going to be bad for IULs, because the bottom line is what really matters is the options budget and the options costs, and the environment that we're living in right now. It's just not conducive to IULs performing well.